Okay, I'm Dan Rundy. I hold the Schreier Chair. We're going to be talking about DFIs in a changing global economy. We did a report here at CSIS called Development Finance Institutions Come of Age. We did it in partnership with ODI last year, and we found that the sector has grown to about $70 billion, which is, if you compare that to official development assistance of about 140, it's about half. And it's been growing extremely rapidly over the last 15 years. We believe it's going to surpass traditional ODA sometime in the next 5 years. So DFIs, that's the good news. The other part of the good news is that DFIs are now a central part of the conversation about development. If you look at the Addis Ababa agenda and billions to trillions, if you look at the SDGs, they're talking about how do we crowd in private capital, et cetera. That ultimately, that we are, what's happening is that the good news is that DFIs are at the front of the conversation. The harder part of this, though, is they're going to be asked to do things that are less comfortable. They're going to be asked to go to difficult places, conflict-affected states, smaller transactions, and they're going to be asked to make some specific changes to their business model as a result of this. And to the extent that they don't, there's lots of soft money waiting in the wings to get involved with this, and there's all sorts of dangers to that too. A lot of people who are in the grant-making business who may or may not know what they're doing, who are happy to kind of step in if DFIs won't step in. So I think there's a challenge and an opportunity there for DFIs. It's also, so it's been a real pleasure to work with EDFI as part of this work that we've done on this. But without further ado, I'm going to turn over the floor to my friend Nano Kleitorp, who's the chair of EDFI, to make some remarks. He's just written a very interesting book called Banking for a Better World. I actually read the entire book. I recommend that you will read the entire book. I think it's quite an interesting précis for the entire sector, and I recommend it to you highly. So Nano, come on up. Give us some remarks. Thanks very much.
Thank you very much. Thank you very much, Dan, for helping us to set this all up, and thank you all for coming here on a topic which I think in development finance is very important, and on an occasion which is the 25th anniversary of the EDFIs. When I started working with FMO about well, a long time ago, 30 years ago, FMO was a small development bank, and in reality FMO was insignificant in let's say the space of the whole development policy of the development aid agenda as being a development bank focused on the private sector. And I think that is true for all the DFIs and EDFIs if we look back. So if we look, because it was very much public sector focused, governments were focusing on the public sector. The public sector should make the difference. The public sector should, let's say, provide the conditions that are jobs, that provide services, look at how to reduce poverty and create economic growth. And the private sector was looked at, well, they are making profit, that's their main business, and that doesn't contribute too much to a better world. I think that is maybe a little bit black and white, but that is what it was a long time ago. And the big changes, and I think it has to be mentioned a lot of times, is of course 2015, Addis Ababa, Development for Finance, where it was stated for the first time, I think it was, of course, that's a result of a process of several years, but it was stated for the first time that the private sector is key, that governments cannot do it anymore alone, that official development aid is not sufficient to really get to the Sustainable Development Goals 2030, which are incredibly ambitious, of course. So it's clear governments are seeing that ODA money is scarce compared to, let's say, the needs there are, and how do you get more private sector involvement in financing those ambitions. And that means that today, DFIs are becoming much more, or are in reality, in the center of the development aid and of the development finance agenda, which changes the whole playing field for DFIs, and which, as Dan mentioned, creates a lot of new challenges. Welcome, Martin. It's great that you're here already. Yeah. I was worried that I would get worried if you would get on time. So it's fantastic to have you here already. So they are becoming, development finance institutions are becoming much more in the center, and to see how they can help to mobilize and support to mobilize that private money for the SDGs. But let me look a little bit, we are 25th anniversary, a little bit back. And so EDFI was created in 1992. The EDFIs were created in 1992. That was 7 DFIs that started. It was all quite small. I think we had a total balance sheet of about 1 billion. Today, the EDFIs, we are 15, and the total balance sheet of the European development finance institutions is about 50 billion. So that is, in the big picture, of course, it's still small, but it is getting really an impressive growth. It has been a growth over more than 20 years of more than 10% a year. There are not many companies, I think, that can say that over such a long time they have been consistently profitable and they have been consistently growing. The interesting part of the EDFIs is, of course, that it is a diverse group. It's a diverse family. We have all kinds of different family members. So there are smaller ones, there are bigger ones. We all have, I think, very similar values, promoting economic growth, looking how to mitigate climate change, how to build business models which help to keep us within, or help to keep us and to get us within the ecological boundaries of this planet. We're all looking at promoting those new business models, getting access to finance, services, clean energy. And if we look at the total portfolio of the EDFIs, we see that there's a huge emphasis on SME finance through the financial sector, strengthening the financial sector, and through the financial sector creating access to SMEs, to MFIs, of course, for microfinance, very much on renewable energy. At the same time, what we see is geographically, we are very focused on Africa. More than 30% of our portfolio is in Africa. And that makes us, because the diversity and reality makes us a very interesting group of organizations and institutions, but because we can learn a lot from each other. Because everybody is doing it in a little bit of a different way. Some are more focused on equity, others more in debt. Some are mobilizing already today pension funds with their flows of money. Others are already have a lot of experience in blending. Another aspect is that really the standards we have today, the ESD standards, are being, let's say, created or have been created by the DFIs together. That's EDFI, that's IFC, EBRD, and those standards are now commonly accepted standards in the markets where we operate, in Africa, Asia, Latin America, with the companies where we operate. And that has been a long process, and there's still, of course, a way to go, but that is really, I think, one of the benefits and one of the results the DFIs have brought to the market. If we look where there has been really significant change because of the intervention of the development finance institutions, then we look at the microfinance market, completely created. Let's say there was a basis already, but created, and the scale which it has today has been because of the equity participations and the finance provided by the development banks. If you look at the mobile phone industry in Africa and in fragile states in general, also in Afghanistan, if you look at the smaller countries in the Caribbean, that was made possible because of the long-term finance and the long-term view of the development finance institutions. institutions. The private equity markets, similarly, the private equity markets 25 years ago didn't exist in Africa, in Asia, and in Latin America, and today those are important markets and important asset class that has been created. So all in all, if we look at the size today of the development finance institution together, the portfolios, we're talking of several hundred millions of billions of dollars, then we could say a new asset class has been created. And it's important to talk about this new asset class because we need to scale it up, as we said. We need to scale it up because of SDGs, and we need others to invest in this asset class. And with the experience and the track record over the last 40, 50 years, this asset class has shown that it's focused on creating impact, on creating jobs, on climate, let's say mitigating climate change, on getting decent job, better standards. And this focus has been gone along together with making a decent profit. So it is possible to do good business and to be profitable. And that's what we want to show to the world, that that is possible, that it is doable, and that it is an important asset class to invest in for the coming decade. And that it is crucial to get to this better world and to get closer to realize the targets of the Sustainable Development Goals. We have been very modest, I think, over all those years, what the results are and how we got there. And it's important for the DFIs together, and that's in these days we are talking about that, and we have to make that work to get a better understanding of that asset class, to get a better understanding of the DFI for governments, for our owners, and for the private sector in order to crowd them in. Because the ambitions and the targets and the challenges, of course, are huge to realize what is needed for this better world. So, at the same time, we see that for governments, it has been relatively cheap, with less than 1% of yearly of their ODA budget. Now we have institutions that altogether, most probably in the coming years, will surpass the total amount of ODA yearly. So it is a very efficient way of investing. With this success and a significant role, of course, there comes a lot more responsibility for the DFIs. So be more transparent and looking how we can lift out those more than 700 people out of poverty. That responsibility is, when you are in the center, something relatively new to us, because that means we have to step up in our ambition, and we have to step up in showing and branding what we have been doing. Since, I think this year, but since Addis Ababa in reality, blended finance became the buzzword. And since Addis Ababa, we have seen already a lot of blended finance available to the market. IFC has this IDA window of 2.5 billion. The European Union is almost ready in creating the external investment plan, which is also blended money. We see a lot of governments creating also pools of blended money. So those are fantastic opportunities to crowd in the private sector. And at the same time, if we don't use it badly, and that's where the responsibility of this community is huge, instead of creating markets, we could destroy markets. And instead of going from billions to trillions, we could go from billions to millions. And that is something which we have to avoid. And one good step, we said yesterday, and hope will be said on Sunday by the multilateral development banks, that is accepting these principles for blending finance, when to use it and when not to use it, and to create, let's say, a forum where we can discuss when we see things are in the eyes of one of the DFIs, not managed rightly, or when subsidies are used and are not benefiting the creation of markets or really reducing risk for the private sector. So I think those are steps which are very important and which help to keep the discipline in order to deploy this money as effective and as productive as possible. If you look at the challenges for the DFIs going forward, then I would say that this mobilization is a huge challenge. We have to try to mobilize, let's say it's about 1% of the, between 1 and 10% of the annual global savings that getting in the savings pool. So that's in our markets, the pension funds, that is mobilizing pension funds in in Europe, in the United States, in Japan, to convince them to invest in these markets, because we have to scale up. At the same time, we're talking about blending and we're talking about money and from billions to trillions, but of course it's not only all about money. There's a lot of other things that have to happen in order to deploy this money, in order to reach those goals. We need an enabling environment. We need a good legal system. We need projects, because it's also with this growing amount of money and with the ambitions there will be, and there is in some areas already, a lack of bankable projects. So we as DFIs, together with let's say private sector players, together with governments, we have to see how we create and how we get to more bankable projects. Another discussion is, and that has to do directly also with crowding in the private sector, is standardization. Just this morning we had a meeting with several DFIs. We were talking about how are we going to give access to our assets, to our investment pools, to the private sector. The only way that we can do is that we are more standardized. There's still too many different standards, too many different ways of measuring, too many different policies. The only way that we can make this work is standardized and making it easier for private investors to be able to pool with us and create this scale. Other important challenge is local currency. Still, we are financing far too much in hard currencies. And that has a huge effect on the debt in the countries. It has a huge effect on the affordability of prices of energy. So we have TCX, of course, what we have created, the foreign currency hedging fund. Ruud Brouwer is here, and so if you need for local currency, you can find him there. But that is not big enough. It's not. It's doing a fantastic job. It's growing, so we see there is more need. But we have to come with more creative solutions still, because it's not acceptable that we go on financing local currency earners in hard currency. So that should be an important ambition of us all together to go and do more local currency where that is adequate to do. To finish, I think we cannot do it alone. The EDFI cannot do it alone. All the DFIs together cannot do it alone. We need to work together. We need to work together with the private sector. We need to work together with our governments, which have supported us over all those 50 years and have made it possible for us to create the impact that we have been creating, and to do that in the future too. So together we need to have a shared voice on development finance for a private sector, and that's the way that we can contribute to this better world we are all looking for. Thank you very much.
Thanks, buddy. Thank you. Okay, I'd like the panelists to come on up here, please. Thank you. I think we're okay. Okay. We've got 4 very interesting panelists. We have David Behigian, who's the Executive Vice President of OPIC. We have Linda Broekhuizen. How's that? Linda Broekhuizen, who's the Chief Investment Officer at FMO. We have Alain Ebobisse, who runs the CEO for Africa 50, but I knew him in his past life at IFC. And we also have Joachim Nagel, who's the General Director and incoming member of the Executive Board at KfW, so a shareholder's perspective. Thank you for being here. Okay, David, let's start with you. We hosted an event here in April on the evolving role of OPIC. I wrote an article in Forbes.com that says OPIC ought to be put on steroids, not zeroed out. There was a skinny budget. The Trump administration's original budget, as far as I could read it, said that there was a belief that they should zero out OPIC. I'm thrilled that you're here, and I'm thrilled that you were confirmed. So could you just talk about what's going to happen to OPIC? Thanks for being here.
Great. Well, thanks for setting low expectations.
Yep.
As I've been telling some of my colleagues around the world, I've been quoting one of my favorite authors, Mark Twain, to say reports of OPIC's death are greatly exaggerated. I think there's 3 points that underscore that. First, a closer reading of the budget, when we went from skinny budget to the longer budget, was the opportunity that OMB identified for reform and what we like to think of as modernization. So as we've noted, it has not been reauthorized in almost 10 years, and some of the authorities really date from early in our existence to the 70s, and it's time for OPIC to look to the next 50 years with additional authorities. Second, I think there's ongoing bipartisan support on the Hill, as evidenced by the confirmation hearings that Ray Washburn and I went through, and I believe that that only continues to grow as people look at the role of development finance around the world and the role that the United States needs to play as a leader there. And then last, when you look around the administration, I think stronger and stronger support has been evidenced by what President Ray Washburn has said is his builder mentality, to be able to look for equity authority, which is a long-term goal for OPIC, as well as to raise the cap right now, $29 billion.
The credit card limit. The
credit card limit, that's right. So hopefully you'll see OPIC, if not me, on steroids in the weeks and months ahead.
Absolutely.
But there's so many challenges out there that I think the United States government can tackle through development finance, and I think people are coming around to what Elizabeth Littlefield said last year. It's an agency whose time has come, and I think for development finance generally, its time has come.
So let me just push you just a little bit further. So end of 1 year reauthorizations, regardless of authorities, whether it's called OPIC, whether it's called a development corporation, whatever you want to call it, are we going to have more than 1 year reauthorizations for OPIC, which is a problem from, I believe is a problem, or is a drain politically and a lot of energy for management to have to deal with?
It's a goal. I don't do congressional prognostication. So I know that right now, when you look at the folks in the Senate Foreign Relations Committee and the House Foreign Affairs Committee, there's a movement toward that. And again, I think when you talk about putting OPIC on a footing for the next 50 years, that doesn't come through 1 year authorizations. Yeah,
I would agree with that. Linda, thanks for being here. We're here at the 25th anniversary of EDFI. It's not EDFI anymore. It's the new improved EDFI. And, you know, when you guys started, it was sort of a real glimmer in the eye. It wasn't really, it really wasn't, I mean, this is now a much bigger, I mean, you have $50 billion all of your members together. I mean, that's a big number, and I know it's growing. So how's the sector changed? Nano talked about it a little bit, but what are you looking out on the horizon? What's in your inbox at FMO, and what's in your inbox for the sector?
Yeah, thank you very much. I'd like to refer to an interesting discussion we had yesterday evening with EDFI and IFC together. And we talked about DFIs as an asset class, as Nana already mentioned. And we see that DFIs have become an interesting and big asset class to look at, however, not being very well known or well defined. And that's from two perspectives. One is the institutional investors, and as FMO and some of the other EDFIs, they're working also with institutional investors, with commercial investors, who not always understand that we have a very solid track record in, for instance, Africa, in Asia, and Latin America. When we mention those regions, they get kind of a blank vision, looking at us as a black box and then still providing solid returns. So we need to explain a lot what we are doing and why we have such a strong track record, as Nana already mentioned. year-on-year growth of 10%. We have experienced that as FMO as well, which comes with challenges as well. How do we manage that? How do we manage the growth? And what has changed largely over the past even 5 years, I would say, is we have become more visible for many different stakeholders, and that has increased the complexity. We work now not only with our clients in emerging markets, we also work, as I said, with institutional investors who talk a different language, who have a different lens. We are more visible and more relevant for donors, for our shareholders, for governments, where we can really contribute to the Sustainable Development Goal agenda that we have embarked on globally together. At the same time, we need to also, from that perspective, explain what we're doing and how we operate. And there are quite high expectations sometimes about what we can do and how fast we can grow and how fast we can develop. So that is one of the major challenges. We have NGOs, we have, for instance, we are a bank, so we need to report on new regulation, new standards. So the complexity has increased. And then I will round off what we noticed as well in the management board, for instance, of FMO, that we are dealing a lot with expectation management. How can we actually be relevant for many different stakeholders who have different expectations, who have different ambitions, and we try to combine it as much as possible. We do that by expanding the asset class to institutional investors, but also working with blended finance. And blended finance, working with governments, is really about the asset generation of the future. It's higher risk, it's more innovative, it takes more time, but it is needed to also generate the assets because there's more and more funds coming available.
Great. Thank you very much. Joachim, thank you for being here. Clearly, governments like Germany's are thinking about how to use institutions like KfW and other sorts of DFI instruments to, I know Germany, for example, has proposed a Marshall Plan for Germany. I know that in Europe, issues such as, excuse me, sorry. Right.
70 years behind schedule.
I'm a little,
70 years.
Yes, right. Marshall Plan for Africa, right. I'm a little, it's a Freudian slip, but but Joachim, you have a Marshall Plan for Africa, and you've got as many as 400 million young people that you're going to have as a youth bulge in Africa. And so they're either going to prosper and grow in Africa or they're going to go someplace else. So I know that's on that's in your inbox.
Yes, thank you very much, Daniel. I do hope that the Marshall Plan for Germany is not necessary anymore. But we will see. So thanks for having the chance to participating here in that panel discussion. So to say it very frankly, I'm rather new in that business. I'm a former central banker. I was board member of Deutsche Bundesbank during the financial crisis, and I had the responsibility within the board for financial markets. So I'm more or less a little bit influenced by what all happened during the financial crisis in Europe. So I know from that having, let me say, robust domestic financial markets are key for developing a country. And I think this is also true, and this is also the same message I would deliver for development banking. I think this is also true what the German government addressed in the G20 initiative for a compact with Africa to more or less crowd in the private sector. Just to give you maybe one number, I think this number is for me a textbook example, a perfect textbook example for a credit crunch situation. More than 50% of small and medium-sized enterprises, and I guess it's a little bit more if you include the informal business in Africa, they do not have access to loans. And that is, for me personally, that's not acceptable. And that is the reason why I believe that DFIs are so important for that business. And that's exactly the point where I believe that the DFIs plays an incremental role. They should serve as a kind of a catalyst to more or less freeze or solve dysfunctional markets. And this is my perception of what the DFIs did in the last decades. And in my interpretation, I know you have an anniversary that is, for me, it's a success story that the DFIs, what the DFIs did over this 25 years. So I think this is an important role DFI should also play in the future, and a more pronounced role on top. We should be more innovative to have more products that are serving the needs of developed countries. I think I guess, a little bit far away. We are still a little bit more, let me say, dominated by the thinking of developed financial markets. But I think this is not what maybe less developed financial markets needs really to really deal with their issues. So we should be more or less more innovative, and I think that is the reason also why I believe it is also necessary to bring in the private sector also from the financial market perspective. And I guess what the German government did regarding Africa, compact with Africa, I believe that is well understood by the, I guess also by the new government that will run maybe the next 4 years. I believe there is a lot of momentum in that business. And I believe also that it's a kind of a window for all the DFIs to step in and do an excellent job. Thank you.
So Joachim, let me just push a little bit. Since you were involved, have been in financial regulation, you were on the Bundesbank. There's this obscure topic called Basel III, and then there's this thing called Basel IV. Now, so many in this audience may know what it is, some may not know what it is, but in essence, it's a series of regulations set up to regulate banks and how much money they have against any lending that they do. And as a result of that, and that for very good reason, that Basel III was set up in response to the global financial crisis. There's a little bit of an unintended consequence that there are now banks leaving Africa. There are now many companies, some of the DFIs here have portfolio investments in banks, and the banks are either lending less or they're seeing other commercial banks getting out of Africa. So you've been on the regulatory side. You're now at KfW's board. So what's your reaction to that?
I think this is not a fair question to a former central banker, because there are still two hearts that are here in my chest. I think on one hand side, I really knew from the financial crisis how important it is to have a stable banking sector. I think this is a conditio sine qua non for sustainable development. On the other side now, I learned in the last 12 months, okay, there could be a different storyline because the KfW is fully fledged supervised by Bundesbank and BaFin, the national banking supervisors in Germany. And we have also, it's a very complex situation at KfW, and we have maybe the first case in the European history that a daughter institution of KfW, the IPEX Bank, is supervised by the ECB because they are crossing the threshold of 30 billion euros. So it is a very special situation. So KfW at all is a difficult animal, and I'm often, let me say, a little bit jealous on those DFIs that are not fully fledged regulated. That is for sure. But believe me or not, at the end, I believe it is important to have robust banks. So I guess that we are all smart enough to deal with this situation, despite the fact that there is maybe a Basel IV and there is maybe this new output floor of 72.5%. I guess we can deal with that.
Okay. I think we'll just have to stay tuned, it sounds like, but I hear you. Thank you very much. Alain, thanks for being here. You're with Africa 50. You've been at the intersection of DFIs and infrastructure for a long time. I really appreciate you being here. Thanks for being here.
Thank you. So thank you. Listen, the remarks that I would like to make, at least at the beginning, Africa 50 is the kind of a new kid in the block in the DFI community. This is an infrastructure investment platform that was created by African governments. So far, 25 African countries are shareholders of Africa 50 and the African Development Bank, plus 2 African central banks. Basically, the question that I get asked many times is, why were you created? Because there are so many DFIs already in the market, and why create another DFI? Clearly, Africa 50 has many features of DFIs, but we were created precisely to try to operate slightly differently. First of all, we will only do one thing, which is to focus on infrastructure sector through private investment and project development. That's what we will be doing at Africa 50. So we capitalize today with not too much money. We have less than $1 billion, 830, compared to the needs that we see in Africa in terms of infrastructure needs and the infrastructure gap, which is huge. But we believe that one of the things that we need to do to try to help solve this infrastructure gap is to focus on project development, early stage project development. allocating resources, financial resources, but also human resources. I would argue that it's actually the most scarce resources is the human resources of people that could focus on developing this project to build up the pipeline of bankable projects. My experience is that when projects, infrastructure projects globally are ready for financing, one can find the debt financing and to some extent the equity financing to finance those projects. Our biggest challenge is how to scale up. Now, DFIs are already doing some work in that area, but we need to scale up. A couple of figures in Africa. We are only getting in Africa about $5 billion a year of private investment in infrastructure according to PPI database. When you see that the gap, the investment gap on the continent in infrastructure is close to $40 billion a year. So the investment requirement is 130, but the gap today is about $40 billion a year. If the private sector is only doing $5 billion a year, we are not going to be able to close that gap because everybody acknowledges today that government won't have enough money to step up to the plate. Of course, government have to continue to invest in infrastructure, but so Africa 50 was created to be proactive, risk taker, to bet on Africa, but also to push African governments to move a little bit on the, actually not a little bit, a lot on the regulatory reforms so that eventually we will not be needing DFIs. But in the meantime, we need to find ways to try to grow that pipeline of bankable projects, and that's what we're going to do. We will invest equity. We won't compete on debt because there's quite a bit of debt, at least for the needs that we see today in terms of the market in the infrastructure space. We'll invest equity, but more importantly, we will invest project development finance. And before joining Africa 50 as the CEO, I was at IFC. I was also running the infrastructure business, the project development business in infrastructure. And in many emerging markets, we see the same issue in terms of not enough good projects available to receive the funds which are sitting on the sidelines. I can tell you, there are many investors potentially that would come and look at projects and invest in projects if those projects are ready. So we would apply those kind of techniques that we saw in other emerging markets to see whether we can scale up this infrastructure pipeline in Africa.
Thank you. Thank you. Martin Wolf, thanks for being here. Loved your book, Why Globalization Works. You're a global economics commentator for Financial Times. We're doing a little bit of an unusual agenda for this event, but we wanted you to give a chance to give a keynote in between our panel conversation. Given that it's the annual meetings, there's weird arrangements like this, but I'm so pleased you're here. I was rereading your book, Why Globalization Works, over the weekend, and it's a wonderful read. It's elegantly written, and it's a great defense of many of the assumptions that underlie the DFI sector. So I'd be happy to either have you speak from the podium or from the table, either one, but I'd like you to come up now and give your remarks, either one. Thank you. And please join me in welcoming Martin Wolf.
In fact, that's up. You're not actually expecting me to use it, or is there a clicker? In which case, I can.
Clicker? You don't have, if you want to, you can. We can get you a clicker. But if not,
well, I think since you've got to the trouble of putting it up, it might make some sense.
Yep.
Because some of the charts are pretty.
Yep.
Which is always helpful.
We love pretty charts. That's
okay.
Great.
So. It's an honor to be here. I can think of absolutely no good reason for having been invited, and I can't really think of any good reason for my having accepted it. I'm very bad at the word no. But one of the reasons I thought it would be quite good for me is to talk about something I don't know anything about. Would force me to learn a little. The price of this, of course, is you're not going to learn very much, but that's the problem for the organizers. It's their fault. So when I thought about what can I do in my 20 minutes, I do have a little intersection. Those of you who know anything about my now very long and slightly strange career is that I spent 10 years at an institution. I'm not quite clear whether you regard it as a friend or an enemy, but anyway, it's the World Bank. And I had quite an interesting career at the World Bank. as an economist, and though this is not directly relevant to you, my very, very first job there, which is in 1971, before I suspect many of you were born, was in what we call development finance companies, which was were public entities or semi-public entities. Most of them later became private. Some of them became very famous institutions like ICICI in India, which were charged with the job of lending to private business and create. The thing I learned in the 6 months I did that before I was moved on to working on Africa, East Africa actually, in '72, was just how difficult it is to do this. So I sympathize with you. It's a great challenge and very important. So let's see if this works. No, it doesn't work. What am I doing wrong?
Hey, Chris, can you come here, buddy?
Which is the clicker that...
You need some kind of electronics PhD to figure this stuff out.
Ah, now it's on.
Okay.
It's always good when it's on. Actually, no, it isn't on.
So can we just move
Yeah, never mind. Never mind. What I'm going to talk about in my 20 minutes, of which I've already taken 3 minutes, I'm going to divide my remarks into 3 parts. The first part is about things I really know about.
It's the magic of technologies.
It's just distance.
Yeah.
Okay. The first part is on things I know about but are probably irrelevant to you, but never mind, it's fun. The second part has an intersection, which is about what the Sustainable Development Goals mean if you take them seriously. I don't know whether they should be taken seriously, but they are a commitment of your governments, so you should take them seriously. And finally, then I'm going to talk briefly about what the role of your institutions might be in this broader context. So if I can move on to the next one. Can I move on to the next one? This is really a very important part of the global context. I haven't updated this for the latest forecast because they only came out yesterday. But basically what it shows is that over the last 6 years, the IMF has been progressively downgrading its forecast for the next 6 years' average growth of the world economy, the advanced economies, and the emerging and developing economies. And in April this year, and again true now, this downgrading has stopped. So we're now, for the first time in a world where we're not expecting anything like the growth we expected 5 or 6 years ago, let alone what was expected before the crisis, but the downgrading has stopped, and we are now in what looks like at least a very strong cyclical upswing. And that's a very good background for, provided we don't mess this up, for everything that you are concerned about. The only other thing, there are many other things to be said about this chart, but the only other thing that is important to note is that in aggregate, emerging and developing countries' growth has also declined a great deal, but it remains far above that of the high-income countries. The second chart, if we can get to that, can we get it out? Good. This is maybe a bit difficult to read from here, but I think it's this.
The other pictures, it's more visible.
Yeah, anyway, this is the most important single chart about our world from an economic and political point of view. There are many other charts that are very important, and one of them, it shows the shares in world GDP of the major regions of the world since 1980, forecast till 2022, and what it really indicates, and which is, I think, of immense relevance to you and all of us, is that we are in the middle of a transformation which is not historically unprecedented in the sense that the reverse happened in the 19th century with the rise of Europe and America, but the reversal of that is occurring at an absolutely unprecedented speed. So back in 1980, the developed countries in aggregate still generated 2/3 of world GDP at purchasing power parity, and by 2022, this is expected to be about 40%. That's an immense shift. And the offsetting rise, this is the second crucial point, is entirely, exclusively in East and South Asia, and of course overwhelmingly in China, which is the great yellow river you see exploding down to the right. And that, of course, means, and I think this is very important for you, we're not going to be able to do anything important globally without cooperation with Asia. This is no longer a Western world. So that's the second point. Now, if I go to the third point, can I go to the next slide? Third slide? Right. This is one of my favorite slides because it tells you who's going to dominate global capital markets in future. We're not there now, but it's where we will get to, and I will tell you why we're not there. And this is also very important for you because you're financial intermediaries. So what this shows is the share of China and the US and Europe together in the total flow of global savings. Okay? And so you go back to 2000 and basically China was irrelevant. Today, China saves in aggregate almost as much as the US and Europe together. Now, almost all of that is currently being invested in China, which has the highest investment rate in the history of the world. But that is, as urbanization completes itself, going to stop. Savings rates will fall in China, but they're going to remain, in my view, very, very high. And that flow of savings out of China is going to become the dominant factor in world capital markets, just as the flow of savings in the US in the late 19th and early 20th century became the dominant factor in global capital markets for the succeeding century or so. Now, the incorporation of Chinese savings and therefore Chinese capital market institutions and banks into the world system will be the biggest challenge in the financial sector, in my view, of our lifetime, and it will make the global financial crisis look of nothing of particular importance. And it will, of course, completely change where investment is done and how it's done. So that's the third big point I wanted to make. And the fourth, next chart, is the future of globalization, or question mark. These two lines show, the brown line shows the ratio of external financial assets and liabilities to world, or actually to the GDP of the major economies. And the brown line, you can read that off the right side, shows the ratio, the green line, ratio of trade to GDP. Can be read off the right scale. And the basic story is very simple. We had a massive expansion in globalization. You mentioned my book, which reached a peak about 2008, and since then it's stabilized. It hasn't collapsed, but stopped growing. And there are some measures in which it shrunk. One of the biggest questions in thinking about the future of the world economy is, will that continue as it is, stabilize? Will it rise again, or will it go into reversal? And I think there are very powerful pressures on both sides of this balance, and it will again shape very much the environment which with you operate. And the final chart on global transformation, I think I'm roughly on time, is the brilliant job we haven't been doing in controlling the emissions of CO2. This is from US sources. You can see the regions. So the red at the bottom is the EU, the white is Japan, the US is yellow, and then you've got China, and above that, basically, India and the rest of the developing world up to about 2012. And basically what it tells you is what you all know, is we have continued, the flow of emissions has continued to rise consistently, never mind the stocks, so it's rising at an accelerating rate. And the whole story, and this is incredibly important for the SDGs, I'll come to that in a moment, is now developing countries. That's the dominant story. The US remains a very big player, and of course if the US drops out of the system, as it's suggesting, indicating that it's going to be very difficult to persuade anyone else to control their emissions, but the emerging countries are the dominant issue in this context. So that's my sort of 6 main points about what's going on out there which really affects the environment. Let me then go on to my second section, which talks about the Sustainable Development Goals. Who is furthest from achieving them, and above all, why poverty matters. So let me just go to the next chart. Next thing, I've just listed, what I've done is I've gone through the SDGs, and I've just knocked out, or I've just included here, you probably know them all, how many of them depend directly on achieving higher GDP. How directly related the achievement of these goals is to achieving higher levels of economic activity, and particularly in poor countries, and I'll confirm that later on. So we promised to end poverty in all forms, to end hunger, to ensure healthy lives, ensure availability and sustainable management of water and sanitation, ensure access to affordable, reliable, sustainable and modern energy for all. These are enormously ambitious, real economic goals. Can you go to the next one? Promote sustainable growth, obviously directly related to growth, build resilient infrastructure, reduce inequality. Well, that's not directly dependent on growth, it's more on the inclusive nature of growth. Ensure sustainable consumption and production patterns, take urgent action to combat climate change and its impact that will demand immense investments. Move on. Conserve and sustainably use the oceans, again, huge investments required there, and protect, restore, and promote sustainable use of terrestrial ecosystems in many different aspects. Again, huge investments will be required. So the planet has apparently agreed to do some absolutely staggering and heroic things in a relatively short time. Now, I'm not suggesting they're going to do this, but it's pretty clear that if we're going to do that, we are indeed going to, or even get anywhere close to, we're going to have to achieve extraordinarily high levels of investment across the planet, particularly in poorer countries, and really very rapid rates of growth in the poorest countries. If we look across to the next the next line, I went and looked at, I thought this was interesting, at a report produced by Jeff Sachs, whom you all know, and a number of colleagues, on analyzing where countries are in relation to the Sustainable Development Goals, and therefore the countries which will need the greatest help to achieve them. Nobody, by the way, on these goals is at 100%. No one is close to it. The top 10 in their list, you will be pleased to know, this seems very appropriate at this meeting of European Development Finance Institutions, are Sweden, Denmark, Norway, Finland, Switzerland, Germany, Austria, Netherlands, Iceland, and the UK. So they're all Europeans, so congratulations. Europe has apparently done something right. Maybe Europe carefully wrote the SDGs to ensure that it would come out top. I have no idea whether that is true. But the important point is to look at the bottom 15. I don't have, I could have gone bottom 30, but the list is so long. So there are countries like Gambia, Yemen, Sierra Leone, Afghanistan, Madagascar, Nigeria, Guinea, Burkina Faso, Haiti, Chad, Niger, Congo, the Democratic Republic of Congo, Liberia, Central African Republic. I mean, the obvious point is that the countries that are furthest from this, achieving these goals are, and this goes on further, the world's poorest. There's no surprise in that, but it indicates that even if you take a very broad view of development targets and goals, raising incomes, achieving higher levels of income is essential. By the way, just for your information, China is 76th and India is 110th. So let me now just briefly, in the very last section, where might DFIs come in? Well, and here, I'm not going to tell you anything you don't know, but this is, I'm going to tell it to you anyway. So in brief, it's the growth stupid. Growth is a necessary, though not a sufficient condition for the progress towards these goals that we've set ourselves. It can't be achieved with stagnation, particularly in the poorer countries. Overseas development policy has shifted in the last few years to emphasize, and I think this is right, the private sector role, investment, job creation and growth. It's already been mentioned by earlier, and that's clearly essential. And to make private sector growth work, and it's something I've thought about a lot over the years, you need decent institutions, sensible policies, and you need a lot of money. So it's very difficult to make finance work if you don't have decent institutions and sensible policies, but if you do, you still need the money. And that's the combination which is so difficult to achieve. So finance is, as trade has often been called in the past, is a handmaiden of growth. And that's, if I move on, that's where you come in. as has been pointed out already, following the global financial crisis and during recent periods of net investment outflows from developing countries, you've kept on lending, which is a very good thing. Your portfolio has tripled in the past 10 years. And there are clear evidence that this leads to private sector management. So that you have, I think, a significant role to play in meeting these challenges. If I can go on. As you know, you provide risk capital and long-term finance. You've been doing a lot of lending in crucial sectors, financial institutions, infrastructure, industry, agribusiness. Now renewable energy, private equity, and telecoms. But the really big question is whether your money can be leveraged from the billions into the trillions. This is now a well-known phrase. But the big challenge facing you and indeed the world, particularly now that governments are clearly not going to provide any more money, is whether we can leverage up private money on the scale needed to meet the needs of some of these very, very poor and troubled and often troubled countries. It's an unbelievably big challenge that you have, and I think you have to think big, not only about what you do, but about the global context in which you operate. So my conclusion, very simple. We're in a world of extraordinary transformation, confronting huge challenges. Some of the challenges are the product of failures, namely the fact that there are many parts of the world which haven't grown as satisfactorily as, say, Asia has, and some of the products of success. We have generated vast increases in income on the basis of the use of fossil fuels, and I think all sensible people know we have to move beyond that now, and we have to find a way of doing so, and that's the product of success. The world has, as you know, set extraordinarily ambitious, probably unachievable goals. I don't really mind that. You might as well set a goal and do your best, even if you know you can't achieve them all. But if we are to achieve them, there is no hope of doing so without very fast growth in poor countries. If you think back to the Millennium Development Goals, the success in achieving them, which was not complete, came in very, very large part from the success of China and India. So if we don't achieve that in the rest of the world, and now, we won't succeed with any of these goals. And you can play an important role in promoting that growth, both in finance and I would suggest also in catalyzing ideas for incorporating the private sector. So, as I said, I'm sure I haven't told you anything you don't know, but I've said it anyway, and thank you for listening.
Thank you very much. Great. Thank you. Thank you. Thank you, Martin Wolf. Thank you very much. This was great. I think that's a lot of food for thought. So could I ask each of you just to react to what Martin Wolf had to say? David.
Well, thank you. I agree with Martin regarding the profound transformation he's talking about. But as Dan knows, it's fun to have a little controversy on these panels. So I'll say I think you left off one of the key lines in your charts. When you look at global growth and global productivity and global jobs over the last few decades, you'll see 25 to 100% growth across those in this century. What you'll see when you add Moore's Law, which calls for the doubling of computing power every 18 to 24 months, is a 4,000 times increase. So as we move from a global industrial, or a national industrial economy to an international information economy, I think that is a key driver that I have great hope and great optimism that blended finance can be a major part of that, building out that infrastructure for the 21st century. But I would say spot on the indicators, but I'd like to overlay the technological revolution that's happening today that we can be a part of.
Great, thank you. Linda, what's your reaction to what you just saw?
Yeah, thank you very much for your very interesting overview from a bird's eye, interesting to see. I was triggered by one of your remarks where you said for DFIs the growth is necessary but not a sufficient condition for social progress. And I think that is crucial to look at the broader picture. Yes, DFIs can play a role, but it's about sustainable growth. It's about inclusive growth, about a green economy. And we need a multi-stakeholder approach for that. That's what we already saw, working together with institutional investors, with governments, with donors. And that increases the complexity because everybody speaks different languages. And maybe a question to you, how you see how we could organize that, because yes, we can support growth, and we've seen a lot of growth in India and in China, yet they struggle also with how to manage that growth and how to deal with it going forward, committing to the goals. At the same time, we see this as a global agenda, so how can we improve that going forward? And DFIs are a tiny player in this overall field still at the moment.
Joachim?
Thank you very much. I think I don't want to set a depressive, let me say, comment now, but I guess it makes me a little bit depressive because I do not see that these trillions are coming up. If we realize that we are currently in a situation where we have ample liquidity, excess liquidity, and despite that fact, there is not enough incentive for private capital to invest in these countries. That makes me depressive because I see an upcoming period that maybe central banks are withdraw the excess liquidity. So often when this happens, there's a repatriation of liquidity going on. So money is being withdrawn from these countries. So to say it very frankly, you mentioned these 15 goals, how to achieve that 15 goals with less money. I guess it's at the end not possible. But that should make us too frustrating because I believe that DFIs plays an incremental role. It's maybe a tiny role, but I guess it's an important role. And I believe, and it was also true for the Asian countries, if you look back 30, 40 years ago, maybe 50 years, and you've asked one, what is maybe the future of the Asian countries, I guess no one would more or less had that crystal ball to give you the indication that Asia would come up like it came up in the last 20 years. So to set a positive note, despite the fact that I do not see the trillions, I believe that the investor side, with the help of the DFIs, at a certain point in time, they see all the chances that are being offered by Africa, for example. So it will take time. It will not be a quick success story, but I believe it could be a success story at the end of this century.
Thank you. Elaine?
Yeah, two things. First of all, I think the first chart or the second chart on China's share of savings in the global savings is quite impressive. And of course, I represent a DFI that focuses exclusively on Africa. And to be honest, on infrastructure, China is all over the place on the continent. And my job as the CEO of Africa 50 is to make sure that we welcome the Chinese, we work with them to make sure that the projects in which they're investing are sustainable, they're done the right way. But China is a player today, at least in our continent, and they will continue to be a big player. So I think I wanted to mention that. But the other thing that I also quite liked on what Martin said is, I like us, including the DFI community, to be very focused and do a few things and define what we're trying to do. So the ingredients that you outline on what is key for growth, I think building institutions, setting right policies and finance, three things. We need to come up with a few things that we will focus on and do those things well, and this is what will catalyze finance. Finance is really a consequence. If we do those two first things, building institutions, setting policies right, the finance will come. So we are in the DFIs community, we have to even become like leverage machines. Our only focus will be to do what is it that we can do to leverage private sector capital to come into our countries. At Africa 50, this is one of the jobs that we're going to do. The reason why we're going to be focusing on early stage project development, because this is the riskiest part of the equation. You invest a little bit of money, but to bring the entire project financing together. So we would have leverage in excess of 10 times. Well, for projects that would be successful, those that will not be successful will lose the money, but that's okay. So it's about finding ways to leverage as much as possible, as opposed to us ourselves lending the money, because we won't be able to lend much money. So early stage equity investment, partial guarantees, whatever it takes to invest as little money as possible and get the big bang. That's what we want.
Okay, so I want to just ask the question. Not all of you have to respond. If you all want to respond, that's fine. So is China going to bail us out on the SDGs because of the charts that Martin put forward saying there's going to be this massive, I was at some other panel the other day where they're like, well, we're just going to get, the Chinese are just going to have this massive inflow of money and we're going to help us hit the SDGs globally. What's your all reaction to that?
What China is currently doing is, in my interpretation, it's driven by a very rational argument. They're trying to diversify their huge US dollar portfolio. This is the reason why they are investing in Africa. So maybe they are serving as a kind of a icebreaker frontrunner, and that should give us maybe enough arguments that we should be more or less part of that development, not staying behind. I think if you're staying behind for too long, then you're out. Then you're out.
Good. Elaine?
Yeah, yes, look, again, I said without being prompted by you that China is certainly all over the place in some of the infrastructure sectors in Africa. For example, most hydro projects today on the continent are financed by China. And what we are trying to do, for example, at Africa 50, is to figure out a way to work with the Chinese and our shareholders' government so that, you know, some of those projects, once they finance or build, because maybe China has a competitive advantage in doing so, then we can take over those projects and structure concession agreements that will make sure that those projects are sustainable in the long run. So we have to figure out the ways to work with the Chinese and see what are the competitive advantage of each of the capital providers. So I don't believe that they will bail out, you know, all of us because they're basically operating also, you know, furthering their own interests, which is fine as long as the product which is delivered is, you know, a good product for the host country. And we have to find ways to work together. I believe that you know, most DFIs now are, I believe, in the mindset of working together with the Chinese and doing stuff together, because it will take all of us working together to make an impact.
Okay, Linda or David.
China developed a phrase a few years ago called harmonious development, and they worked to define that at a national level. I think what they need to do now is to help define that at an international level, as they have the unprecedented savings rates that we were talking about earlier. Deploying that capital in a way that takes into account what people have talked about as externalities is going to be a big challenge for China, and I look forward to them meeting that challenge.
Yeah, also in the presentation you mentioned. So I also believe, again, there, as you said, Alain, the cooperation is extremely important, and the Chinese also cooperate with governments to agree on conditions for many projects. So not only in the private sector we need that cooperation, but definitely also in the public sector, to make sure that, again, the growth is sustainable and is inclusive going forward.
I'm going to call on some people for the Q&A. I want to hear from Cinnamon Dornsife. I want to hear from Elizabeth Littlefield. I want to hear from Shell Rowland. Okay. So, Cinnamon.
Okay. Thank you.
Okay, and I'm going to give Martin a chance to respond.
Yeah, sure. Cinnamon Dornsife, Johns Hopkins SICE. This is a question for Alain, please. We've talked about the right enabling environment. So good policies, good institutions, finance. We've talked about bringing local currency financing to bear. And so as you sort of think about, and you've talked about partnerships with Chinese investment, especially in Africa, if you kind of think about sequencing what is needed, how would you go about doing so? Do you develop local capital markets, because obviously that is needed, as a prerequisite for sustainable growth and scaling up, or do you really focus on that partnership first?
I want to put this, we're going to put these in the parking lot and we'll get a chance to respond, but I want to give Elizabeth and Shell a chance. Shell's going to pass. I'm going to give it to Bruno. But Elizabeth, go ahead, please. Okay. Okay, Bruno. No.
Okay.
Come on, Shell. Shell, you're as opinionated as I am. Come on.
Thank you. No, my reflection was really on one of your argument, Martin. I mean, the importance of institutions and framework conditions. my argument would be slightly different. It's about stability. If you look at the differences in countries that are successful, it's really about stability. For investors to move in, we can live with institutions and legal systems that are far from perfect if we understand that they are there also a few years from now. And I think that's where we sometimes in the West are struggling. We need to see something that resembles what we see at home, and as long as it doesn't look like that, we struggle. So that's one comment. The other one, I think I must agree about what has been said about China. I mean, my optimism is about China. Only, let me give you one number. China Exim Bank and China Development Fund today have balance sheets bigger than all the multilaterals, past all our multilaterals. And a second number, investment in infrastructure from China or into China from the multilaterals, the same one, is more than China is investing outside. So it's not that our institutions, I mean, we simply not, we struggle to move into to territories that doesn't look like what we would like to see at home. And the governance of our multilaterals doesn't really resemble the overall priorities, the goals that we have for 2030. That's not what we're doing with our money, even the multilaterals, even the DFIs.
Elizabeth, the former CEO of OPIC, thanks for being here.
And nice to see you here, David. Thanks, Dan. Now, one of the things I've been thinking about recently is just, and I think many of you have heard me say this, is that the whole development architecture in our countries has not been adjusted to recognize the role of the private sector. And so I really wonder whether we globally and also individual countries have the political will to change the development architecture in our countries in order to be more efficient and effective and reaching those SDGs. It's, you know, you see aid agencies that are getting in the business of doing private sector development and commercial finance. You see foundations that can't get their head around putting grant money into something that someone else is going to make money off of later on. So basically, I think there's a lot of waste in the system, and it's going to require rethinking the development architecture in our countries and globally to figure out whether we have the right resources, the right skills, the right instruments in the right places to really do the job, and do we have the right plumbing in between the institutions to make sure that, you know, grants over here are supporting financing over here, or referrals are being made from FMO to OPIC to Africa 50 so that the system is using its resources most effectively. Do we have the political will to pull that off?
I have one short comment, and then that's on the issue of institutions. I think this is a new challenge for all of us, because we as DFIs, we can provide the financing. We can also provide a lot of technical assistance to our clients. But we are not very good, and that's not our mandate to help governments to change the environment, make the environment much more conducive, and so on. And that, I think, calls for more coordination effort between the public sector, the donor institutions, and us. And this is, I think, what is also the challenge now with the compact with Africa, because there's a lot of talk how to get things right for the private sector, reducing risk for the private sector, opening markets for the private sector, but this has to be done in a coordinated way. And I'm very much convinced that once this has been happened, then the money is not the issue, then the money will come in. But how to do it?
Okay, panel, can I get your responses to some of the comments here from the audience? David, can I start with you?
Sure, I'm going to paraphrase both Einstein and Elizabeth Littlefield. Einstein said that we can't solve the problems we have with the same level of thinking that created them.
And I'll give you the next one.
Elizabeth has said OPIC is an agency whose time has come. Putting those two together, I think the coordination and collaboration that's possible with EDFI, CSIS, and others will allow us to tackle these challenges in a way that blended finance is coming to the fore, in a way that capitalism and governments are looking to solve problems together in a way that just hasn't happened in the past. So I'm optimistic about groups like this being able to tackle those problems.
Thanks, David. Linda.
Yeah, maybe to add to that, yes, we need more cooperation between donors and the financial sector, being DFIs. At the same time, how to organize that is a bit complex. But what we could start with, what we discussed, as I mentioned yesterday evening, to look at DFIs as an asset class. So the easiest way to start is for us as DFIs to really present ourselves together as a platform, as an asset class, and start a discussion with other stakeholders from that. And that would be the proposal I would have to put it into action.
Joachim?
What I took from all the comments, and it was also my main takeaway from Martin Wolf's presentation, I think what we have to do in development, financing, banking, I think is more or less a kind of a holistic approach. So there are so many different elements we do have to target, and there's not that one single recipe that can more or less at the end solve the whole situation. And I took from one of the comments to rethink what we do in development work. This is also my feeling as a newcomer. There are so many institutions, so many good ideas, but from time to time, and mixing that together and do the coordination work also with politics, that's a very complicated animal. And I have the feeling that we have to do much more coordination. We have to talk even more than we did in the past to have maybe a joint understanding where's the target, what we try to achieve. And I believe that this was an excellent point, yes.
Alain?
Well, first there was a question for me. I think in terms of the sequencing, we know the goal. The goal is to have good functioning capital markets, good institutions, the right policies, but we can't wait to get to those goals. We have to start doing work now. We have to start investing now. And sometimes there are political risk mitigation instruments that can backstop what I call those transition risks. During the transition period, you can actually mitigate some of those risks. But again, no, you have to do things in parallel. And we will do so at Africa 50. But I also wanted to react to other comments that were made. I think there's the comment that actually applies to some DFIs, I suppose not everybody, but sometimes, that we also try in some of the countries, especially in Africa, we're too scared about doing things which don't look similarly to what we see in Western world. So the world is imperfect, of course. The regulatory frameworks are not organized and so. We need sometimes to make those kind of bets, to make those educated bets sometimes, and say, okay, the trend is up. Things are not yet done, but let's make those deals now. And this is what China has been doing in most cases. And I think it also relates to the point that Elizabeth raised about whether our institutions are actually set up to support the bigger role of the private sector. That means whether we have the mindset, okay, we can change policies, and do we have the right also people within those institutions that can actually, shift towards a world where the private sector should be in the driving seat? That's a question mark. In Africa, the African Development Bank, with the head of state, African head of state support, they decided that they would create a separate institution at this Africa 50 to focus on infrastructure exclusively with a commercial mandate. So our procedures, our processes, our people, everybody is geared towards that objective of catalyzing private sector investments. We hope we will be able to achieve that goal a bit better than if we were a big institution with people that are changing in terms of their mandate. Because we have the mandate that we basically building an institution to achieve the mandate, which is to catalyze private investment. So that's my thought.
Okay, may I stand up? Yes. I'd like to respond to some of these because I'll be running away then, and these are fascinating questions. And I hadn't realized how it would go, so I didn't know what this. But let me just start with I want to respond to your pessimism with a good story, I think. So I started in development in 1971. And one of the great books on development by a very great economist, without a doubt, it was Asian Drama by Gunnar Myrdal. And a number of you will know of it, and maybe some of you have even read it. The basic thesis of the book was the immense and overwhelming challenges facing growth in Asia, which, of course, consisted of more than half of humanity, and therefore was the core of the development challenge of the world. And most people in development at that stage focused on Asia. It was poorer than Africa, remember. India was poorer, Bangladesh was poorer, China was poorer than pretty well everywhere in Africa except some of the most landlocked Sahel countries. Remember that. And we are where we are, okay? With growth rates not just in China, but also, and I worked on India for many years as the senior economist in the India division at the bank, was the biggest borrower, and Bangladesh, which is an even more remarkable story, far, and this supports your point, which I'll come to in a moment, far from perfect, but Bangladesh was incomparably the most worrying large country in the world, and it's now richer than most African countries. So it is right to be optimistic. It has happened. Number two, it's happened, and I think this supports 90% because of what the countries themselves do. We all know this. Africa will ultimately develop itself, and Asia developed itself. The outside, and I also agree in asking how they did it. Obviously, political stability is essential. Political stability supported by just enough assistance, just enough functioning government to make the machine work. At no stage has any of these countries, or indeed any of our countries, been perfect. So that's clear. You need a minimum condition. I think for reasons which a number of my friends have just talked about, the challenges in Africa are particularly great to do with the fragmentation, the physical fragmentation from a political point of view, but it's doable. We know it's doable. We're all humans. We can all do this. And that's incredibly encouraging. It's a transforming fact about the world. Because back in 1970, most people in their hearts thought development would fail. It couldn't be done. You know, the Europeans and North Americans would remain rich forever, ever. The Japanese had, for some strange reason, have managed it. And that was that. And that was all completely wrong. So you should be very optimistic. Finance follows other conditions. I agree with that. But then this links to the Moore's Law point. There's a reason. I have a chart which I use on that, and if I'd had more time, I would have done it. First of all, I don't use Moore's Law because that's physical. I use the relative price of semiconductors and processors, which is also fascinating. By the way, these are American figures for obvious reasons. And the interesting thing, it has an important point. I have two important points on that. The interesting thing about the relative price of semiconductors is if they collapse logarithmically, unbelievably. And in the last 5 or 6 years, they've stopped falling. Does that matter? No. My view is actually from now on, what is going to drive the information and technology revolution of our time is software, not hardware. Software is basically dirt cheap. Hardware is dirt cheap. And software is going to change the world. So that's point one. But I agree with that. The second point, in terms of transforming opportunities in very profound ways, which work both ways for now developing countries, the upside is that everyone in the world, pretty well now, and very soon everyone, will have access to all the information in the world in real time. That's just an unbelievable transformation. And that makes development completely different. Of course, it also means that some of the comparative advantages and opportunities for growth through trade and so forth that were very, very important for Asian countries are likely to be rather different now. A lot of that has to do with automation, AI, and roboticization. So it gives and it takes, but I agree completely. If I had another 15 minutes, I'd have talked about that.
Come back next year.
Yeah, because I think that's an incredibly important and interesting question, how it gives and takes. And two last points. What I wanted to say about, I think for Europeans, let's be honest, Europeans and Americans, let's be honest with ourselves, the rise of China is a very uncomfortable reality. So tough. This is the reality. It is indeed the dominant player in Africa. It will become more dominant in Africa, and we are going to have to mesh with their interests and desires, which are not always ours, their views of what works, which are not always ours, but on some things they know better than we do. Sorry, that's true. Doesn't look at what they've done. And if we don't cooperate with them, we won't manage very much, and we're all going to fail. So this is really, really big time. And I know how difficult this is. We found it difficult enough to get you institutions up cooperating with the World Bank. How are you going to cooperate with the Chinese? But you're going to have to do so. And a lot of that will have to be done by the Africans themselves, because they can't have all these different agencies running around us. They've so often in the past competing with one another. Final point. On where I said mild disagreement, I don't want to get which is with Linda. I understand the domestic political constraints that say that we have all these lists of things we want to do, and we must do multi-stakeholder coordination, and I understand the logic of this completely, and I understand the importance of saying this and things. But I have a basic view which I developed when I was working in the bank. I worked in Africa for quite a while, which is one can't let the perfect be the enemy of the good, or we have to keep things a little simple. In countries, obviously, completely non-inclusive, I mean, Angola is not a development model, okay? So that's clear. But if we can get growth going of a kind which generates higher incomes for a large part of the population, which is clearly, in many cases, going to start with agriculture anyway, and build on that, then I think we will have done pretty well. China's growth has in many ways been a real mess from the perfect point of view. Staggering environmental negative externalities, huge increases in income inequality, probably excessive, massive inequalities in treatment of people as they move to towns between residents and non-residents, enormous corruption, clear, but nonetheless, it's worked. So don't be too purist. Thank you.
Thank you. Okay. Thank you. Okay, everybody, that ends our session. Thank you very, very much.